Stocks selling off sharply yesterday as Treasury yields surged to multi-year highs. Rates will be in focus again today as traders await a key speech from Jay Powell at noon. Joining us now is Mohamed El-Erian, Chief Economic Advisor at Allianz and President of Queen's College at Cambridge University. He's also co-author of a new book, Permacrisis, A Plan to Fix a Fractured World. Mohamed, good morning.
Good morning, Mike.
So, of course, we've been talking about the Treasury market. It's using up a lot of the market's oxygen here, clicking toward 5% on the 10-year Treasury. Now, there's a world in which you can say, oh, we're just pricing out imminent recession risk, and investors at the long end are now getting properly compensated, perhaps for the risk of holding longer-term fixed income securities. And there's a way you can find that there's an equilibrium that stocks can reach with this. On the other hand, we're not really repricing the Fed path very much. Inflation expectations are not seemingly behind the move, and the moves have been violent. So how do you read the why of what's happening with bond markets and the implications of it?
So as you say, you can provide very focused answers, but that's not the point. The point is twofold. One is that this market has lost its anchors. It's lost its policy anchor, it's lost its technical anchor, and it's lost its economic anchor. Policy-wise, if the Fed is excessively data dependent, it doesn't provide enough of a forward look as to where it's going. Add to that there's debate about R-star, there's debate about the lagged effects of the rate hikes, there's debate about the monetary framework, there's debate about, as well, what do you do with QT? So policy is not an anchor. Technicals are not an anchor because we have lost the reliable buyers. We've lost the Fed. We're losing China. The latest data show that China is reducing. Institutional investors are underwater. We've lost them. And we may also lose Japan. And then the economic anchors are on there. And then short term, and that's what's of concern, is the inherent stabilizers are weakening. So people who would come in every time yield went up in order to lock in that interest rates have been catching a falling knife. So they're less keen to come in right now. So it's the way in which Treasury yields have moved that raises both economic and financial concerns.
The way I usually try to explain when markets get volatile and they seem to swing around in price a lot is that the market is always hunting for buyers or sellers with conviction. And when there's less conviction on the buy side, it means prices have to go down more to find those buyers who are willing to step in. So I guess it always is a matter of, at a clearing price, we're going to find some kind of stability here. Is there any way you might guess where that is when it comes to yields?
Very hard to guess because you have an inherent asymmetry. We know supply is going to go up, and supply is going to go up in a serious manner because of what's happening to the government deficit. We don't know where the buyers are going to be and at what level. So we will probably overshoot, like you say, in order to find the buyers. The trouble with overshooting is that it causes distressed sales. And that's why the more we move violently like this, the more you risk an even larger overshoot. Now, that's a dynamic, a technical dynamic that we typically see in emerging markets in a high yield. We are seeing it, Mike, in the most important segment of the financial markets, which is U.S. Treasuries. They are benchmarks for so many other things. That's why it's really important to keep an eye on it. We need this market to stabilize.
Mohamed, all of this is great and very important, but we have to get through today. And Powell's talking today. And what we did is took a look at Powell's dashboard. And when you look at that, how the economy has changed since he last spoke at the meeting. Generally, the real economy stuff has been to the upside. When you look at what's happened to retail sales, when you look at what's happened to GDP, when you look at what's happened to jobs, stuff has come in to the upside. Inflation, a little bit more mixed. When you look at the inflation numbers, some of the headline numbers were a little bit higher, some of the core numbers a little bit lower or unchanged. Tell me what you think the message is from Powell today. Does he steer us either way towards additional rate hikes, or does he give us higher for longer?
Thanks, Steve. As you know, it's a very tough situation to be in. He's got to strike such a delicate balance, and the risk of not striking it are high. And it's not just him. We have 6 other Fed speakers today, and people are going to also be looking at them.
But his job is to basically say nothing, Mohamed?
Well, I would hope that his job is finally to pivot away from this excessive data dependence. Because if he retains his excessive data dependence, he's going to have to give a hawkish signal because of how strong the economic data has been in the third quarter.
Mohamed, I got to pin you down on that, though. I'm sorry to cut you off, but to pivot away from data dependence is to provide guidance. So if he pivots from the data dependence, what's the guidance he pivots to?
So, Steve, you know how absurd it is to have this excessive data dependence? You are dealing with an institution whose tools operate with lags. So the notion that you are targeting a forward-looking economy in either 6 to 18 months using data that's backward-looking, that's inherently inconsistent. And yet the Fed has ended up in that trap. That's why.
Well, what else would you look at if you're not looking at data?
They have to pivot to a strategic vision. And for me, we are seeing major inflection points technically and economically. And the message to give right now is the Fed is done. We're done. That's what the message should be. Whether he gives it or not, I don't know.
I don't know. It begs the question of what do you do if you're saying I'm not data dependent anymore. I've already figured it out. I am the great Karnak, and I'm going to go forward with this.
Yeah, but you realize the metaphor of what Mohamed just said is to be looking in the rearview mirror to determine how you turn the vehicle 3 miles down the road.
But that's always been the problem with this.
I know. But it's interesting.
No,
I know we got to go. But
it hasn't been. This Fed has been excessively data dependent. If you look at prior Feds, they took a forward-looking view. It was controversial at the time. Remember Greenspan, remember Bernanke, remember Yellen. It was controversial at the time, but it was critical in anchoring the markets. This Fed has only been data dependent. And now we have issues because we had inflection points. Steve is absolutely right. Who would want to be in a car that is being driven with lots of curves ahead, looking at the rearview mirror?
Were they right? You said it was controversial when Greenspan did it. Was he right?
No.
He was right for a while, but he took his eyes off financial stability. He was right.
I don't want to be in any of their cars.
But he took his eye off financial stability, and there was excessive loosening of regulation.
We really got to go, but this is a great conversation. Yeah.